to the property and casualty industry. And I'm going to have all the speakers introduce themselves here in a minute. But we're here talking about insurance technology and insurance innovation and disruption. And so much of that has to do with data and analytics. But what we wanted to talk about today is what's going on actually in the data industry, because it is going through a massive wave of innovation and disruption itself. And so that's going to be the focus of our conversation today, both from data providers and insurance companies looking to use those data services to solve actionable business problems. So that's what we'll focus on today. Max, why don't you introduce yourself?
Hello, I'm Max Drucker. I'm founder, CEO of Carey Data. This is my 4th ITC. It's really exciting, and thank you guys for joining us today.
Hi, Carey Anne ITC. I'm the founder and Chief Executive Officer of ODN. It's my 3rd year at ITC. I wore a pink dress, a purple dress, and an orange dress, so next year we'll figure out what color palette.
Good morning. My name is Girish Rao. I'm the VP of IT Services, responsible for underwriting and claims at Zurich North America. It's my 2nd year at InsurTech, and for all days I've been wearing a blue jacket.
I'm slightly colorblind, so I won't go into the colors. I'm Hani Ali, SVP for Risk and Analytics at Hamilton Re. So I'm very much more on the reinsurance side, a reinsurer, specialty insurer, Bermuda domiciled. So my perspective's probably going to be a little bit more from the risk-taking side than some of the others.
Hi everyone, my name is Richard Council. I'm the CEO of Stable, and we're a parametric platform that gets involved in commodity price risk insurance. So it's something a little different, and I've worn a grey suit nearly every day of my life.
Thank you all, great distinguished panelists here today. It's my 4th year at InsurTech Connect. I've been in since the beginning, and I have no idea what colors I've worn every year since. So let's, Richard, start with you, and then everyone just sort of weigh in with your thoughts on all of the questions, and certainly if we get questions from the audience, we'll pivot to those. But let's just start by talking about how the data landscape has changed in just the last 12 months.
So there's a real kind of comparison between the kind of the smaller stuff that's really impactful and then the wider kind of macro sense. So we're talking about some of the smaller stuff as simple as like pre-fill. That's made a huge difference in terms of our ability to capture data and standardize it. But then the other side, of course, is the kind of explosion of new sources of data to either price or in our world to validate the customer, because we're purely parametric. So we have to obsess over insurable interest. So these new sources that are coming on that are letting us discover and validate that customer to make sure that they are not speculating, they've got a real business with a real risk. Those are an incredibly exciting new areas for us to really take our business on.
So I'd say the key change that we're seeing is maturity. Some of the data solutions that have been put into the market in the past few years, and there's an ever-increasing number of these, are not fit for purpose when they first get proposed to us as we're trying to look how we might leverage these to underwrite better. But certainly over the past couple of years, the last 12 months definitely, you're starting to see data that is put together in a format that is consumable and can inform a better underwriting decision. And I think the competition that we're seeing in terms of the number of entrants that there are is going to mean that we start seeing a few bubble to the surface as some of those that are less capable fall by the wayside, which is probably needed.
I'll jump in.
So I echo the comment about the amount of data that's being populated right now. What we're seeing is an improvement in the quality of data, not quite where it needed to be, but it is getting there. And we're also seeing how different types of information are being stitched together to make it more meaningful for the carrier as well. The one caveat I would say is that just because data is out there doesn't mean that it could be used in the appropriate way. For example, if you go to social media and there's a ton of information out there about a specific customer, it may not always make sense to use it for your risk analysis. So you got to have that fine balance.
Yeah, I'll say that the way we're talking about data is changing. We're using data to question the values of the insurance industry in ways that we can question and disrupt the fundamental premises of how we select risk, price risk, and process applications, claims, et cetera. So on LinkedIn, I'm very prolific in asking these questions around how are we going to use data now? And that conversation is really starting to transform away from a very technical, very sophisticated, you have to be some math wizard to understand the nuance of the data, to how can we deliver greater value to our customer and return greater ROI to our business? And that's a conversation I think we're just starting to tap the surface of.
So I think it's been pretty slow going in the last few years, and obviously really depends on the line of business, right? Auto insurance has obviously used data for a very, very long time for lots of automation, right? But other industries, and a lot of talk at this conference about commercial, small commercial, right, has opportunity for automation, but there really is still a lot of manual processes in that. And so what I think we're still seeing in this industry is people are looking to how to solve this problem, but not really getting all the way there, right? How do we get small commercial all the way to having real automation and being able to pass policies through just like we do in auto insurance? And so that's, I think, a trend we're going to see in the next year, 2 years, as far as how do we actually drive that, not be about platform, not how do we manually underwrite this, how do we review this, it's how do we actually pass everything through.
So let's, Max, kind of follow up on that and get maybe just a little more specific around your view, and then the rest of the panelists. What are the emerging trends that you're seeing around new applications of data, whether it's operational processes, efficiencies, or what you were just saying is really around underwriting and claims management? But what do you see as the most emerging trends around how insurers are really trying to apply different sources of data?
So sure. So as far as new data, I think falls into two different categories, right? We can look at new ways to solve existing problems. So that's, we have our traditional eligibility questions. We have the traditional questions we have on an application. We've been asking these same questions for literally decades, right? But we have new sources. So we have social media, we have online content, we have Yelp, we have a company's website, we have so many different other ways of being able to get this, but these are the traditional questions, right? So that's really interesting and powerful and important. And we have new techniques. We can do computer vision to be able to determine something is happening here. We can have an AI model where we can predict something is, some sort of attribute is happening. So those are, again, really exciting and important. However, what I really hope this industry moves towards is actually identifying the new elements, the rating factors of the future. Right? What are these attributes that are out there now that actually enable us to be able to predict risk differently, segment our risk, and be able to really look at that? And so does the customer review on a business predict some kind of insurance outcome, right? So does a bar that has good reviews perform better than a bar that has bad reviews, right? These are, I think, really interesting questions, and many people think about these questions. People ask us this kind of question. So I can tell you that restaurants that have really bad reviews, in fact, perform worse than restaurants that have really great reviews and that people really like, right? And it makes intuitive sense, but this is not data that anybody's even thinking about, as far as I know, at least today. And so I think that's the trend that's moving forward. So again, new data and new techniques solve existing problems. That's great and exciting. But what's, I think, ultimately will be transformative, right, and that will ultimately drive adverse selection, right, is having new data elements, new insights, the rating factor of the future. What can we determine about these kinds of, either if we're talking about businesses or individuals, that we haven't had before?
Thank you for teeing up the most perfect introduction to our product, because we're going to raise awareness about some new rating factors that are coming to market.
So I'm an investor in Carey Anne's
Not at
company,
all, but
so
thank you.
Just kidding. I'm really not.
Not yet.
But.
So one really great example of this, we're taking at ODN information about road infrastructure, the characteristics around how wide the lanes are, the speed limit. You talked about people's opinions around restaurants. We really care about roads. So we're looking at things like lane characteristics, traffic volume, previous history of crashes. And we're asking the question, is where you're driving safe? It's something customers really want to know, whether they're on the personal lines or the commercial lines, whether you're driving your kid in a minivan to school or putting him on a bus. You want to know, is he going to get there safe? And is the route that we're taking to deliver a child or to pick them up from soccer practice, a safe one. Commercial fleets are the same way, right? We want to make sure that we're stopping and pulling over in areas that are not exposing our drivers as they get out of the vehicle to drop off that Amazon package to disproportionate risk. But the real gem is it's not only helpful for customer acquisition and for risk management and preventing losses, it's actually a fantastic rating factor. We've never looked at where you are as a rating factor. We know a lot about who you are, your financial history, your demographics, maybe even how you behave. If you have a telemetry device in your car, are you hard braking or are you speeding? But data today is enabling us to quantify for the very first time and contextualize the environment in which you're operating. So if you're an auto insurer, we're currently looking for auto insurers to go file that rate, which is not an easy task. It's a big lift. So if we were talking about where this industry is going in the next 12 to 24 months, I think there's a strong proposition that introducing rating factors is the transformative change, but it's going to take the commitment of those in the audience to work with folks like Carpe Data and ODN to get those rates filed.
So, the amount of data that's coming in right now really helps us not only with new policies, but also look at current policies or renewals in a very different way. Just to give you an example, Zurich's been around for 147 years, and we've had one customer who's been with us for 125 of those many years. So if we were to insure a property for that client, say in Chicago, for all these years, the ecosystem around that property has changed significantly over many years, which means that not only do we need to look at the data related to that specific coverage, but also everything else that surrounds it. So having that insight really helps us continuously make sure that we provide the best risk coverage for our customers.
Yeah, ours is slightly different because clearly we're parametric, but we have a huge challenge to play. We're by some distance, we're the largest parametric insurance platform, over 3,500 commodities, and we're pricing that in real time and giving that portfolio data in real time to the insurers. So we had to learn the hard way. From my background as more like financial engineering, and we had to translate all of that, and we had to visualize all of that data. And my goodness, we made some mistakes along the way, but it was really how to capture that and communicate it back to our carriers. That was the central question for us.
Sounds terrifying. So I'm largely dependent on the data that's going to be provided to me by the ceding insurance or by the specialty reinsurance company that we are covering, and I would still say that it's consistently of a very low quality. So until that data starts to filter through, that still results in uncertainty in the price that I'm going to put on it, and uncertainty in the capital I've got to hold to support that risk. And that's where the opportunity to try and leverage third-party data is compelling for me, because that can allow me to get around the opaque chain between the insurer, the broker, and myself.
That's really interesting. And Girish, maybe you can weigh in on just operational challenges with data providers. So if we kind of go a little deeper on data providers themselves, what do you find are operational challenges as you try to work with the different providers of all of this data?
So there are definitely challenges, but I would not say that it's entirely on the data providers. I think it's a mix. So Hani, you mentioned the quality of data that's coming in is usually pretty low, and I think it's a handoff that happens from one entity to another. So for example, when we get bad data coming in, address location is a great example. I'm sure many carriers can empathize with, you get right next to this post office on this street is your address in your submission process, and then that flows, or that needs to be cleansed within the carrier themselves. So in cases where that flows directly to the data provider, the quality of data that you're going to get back is not going to be that great either. On the flip side, when we get disparate types of data and it's not stitched together effectively, then it doesn't really give us the kind of risk insights that we need internally as well. I mean, remember, this data comes into a carrier's ecosystem, and then it spreads across multiple applications and whatever other use cases. Obviously, you know, if you've got, and every carrier here probably won't admit it, but you've got sophisticated Excel spreadsheets that utilize this data in some form or the other to do your analysis, right? And, you know, you got to factor in that when bad data comes in, it really is pervasive across the organization. So it really is key to make sure that we work closely with our data providers to improve the quality to the extent we can.
Just quickly there, Suresh, just to say the quality of the data we get from Zurich is always of the highest relative quality. So that wasn't a dig at all at the data that's coming in from our insurers.
Great, I'll put that in my performance review for this year.
Anyone else want to sort of weigh in on just the data provider ecosystem?
Well, I'll just chip in because I'll make you feel better. With over 3,000 indexes, like yesterday I was talking to the Peruvian avocado co-op, and these guys don't, you know, it's such an educational piece. You know, they're quite often, the data's great, but they think it's entirely cool just to add a PDF to their website. And there's such an educational piece to say. Quite often, the producers are paying either as a levy or a fee to collect this data, and it's just trying to help them understand both the value, not only in the data itself, but obviously just making life easy for people like us. We're really at the grassroots of all of this.
So I think a really interesting state of the ecosystem is going to be a massive shift, because this idea in insurance that we assess risk at a single point in time, right, is really an antiquated concept, right? We look at this, we price this risk, we underwrote this, we look at a claim, whatever it was at a single point in time, then we don't do that again, right? Again, that's the past, right? Because now we live in a world in which data is continuous, data is a stream, data is constant, and so now we are working into this world in which we can continuously look at what our risk portfolio looks like. And so obviously that's not happening today, and I don't think really any insurance carriers are thinking about it that way, but where I think the data ecosystem is going is this concept of data as a stream and not being a single call and then I forgot about it after that.
Max, I think while that is a delightful idea, it really is, we exist in a situation where the policies are annual, there is minimal to zero liquidity in the insurance and reinsurance space. That is a function of the fact that the policy is required to provide you with a coverage, most commonly for the year, because you have to plan your business for the year. You have to have your car insured for the year. You have to, and when you don't have this, what often happens is you end up with people's insurance lapsing, or perhaps they don't renew their third-party liability cover on their car in the same way that they should. So there's a great deal of risk, and it's all about risk transfer. And until that data flow is established, and I think it's a long way from being established, between the point at which the risk is actually, the insured is looking to get coverage, and the risk is actually being crystallized into a capital vehicle rather than someone who's just passing it along, particularly when it comes to things that have higher volatility. So if you're looking at attritional losses, that's one thing, but once you start to look at the shock losses such as large fires, earthquakes, hurricanes, things like that, I think I can't see that changing in the near term.
So just to respond to that, so I agree, and you have the contracts. However, by understanding what's happening along the way, it gives you many opportunities to be able to offer different things or do something. So for example, so if there's a nail salon that you wrote, right, but now they're doing well, and now they're offering waxing and tanning, for example, right, but that wasn't part of their policy and it wasn't underwritten that way, but we know that along the way, that gives a carrier an opportunity to have a touch point and say, by the way, this is coverage that we want to offer you or that you don't have. Okay, that's one way. Another way we can see that is, say, take the example I gave before about customer reviews. So if we're seeing that customer reviews are either getting much better or much worse, that can be indicative of some sort of insurance outcome. So we can see that maybe that's a retention issue, maybe there's a potential opportunity for loss. So these are ways that provide better ways of having touch points and being able to talk to and going after. So it may not be, oh, we're going to cancel your policy, we're going to reprice your policy. That's not what we're saying. Is that new data and continuous data gives us many more opportunities to be able to have a better relationship with the customers.
Well, and certainly perhaps one of the ways that ongoing data is more applicable is in just claims management. So as we get more information about claims, how do we better serve that policyholder throughout the life cycle of a claim? I can see a lot of applications for more continuous data, certainly in the claims area. And then Max is, already thinking where could that go past that. So we have some questions from the audience, and it matches some of the ones I had. And Annie, why don't we start with you? So the question from the audience is, what does competitive advantage look like when data sets, including new data, are increasingly being made available and used by most companies across the industry? And the piece I was going to add to that is, so how do you really look at ROI? And you have sort of a complex data ecosystem that you're trying to manage, since it's not always coming directly to you. So how do you think about that question?
Yeah, so it's a lovely question. So it's not just about how you get the data, you achieve the value in the data, but it's how you acquire it even, but it's how it's then used. So as we know, we're still embroiled in a fairly manual process in much of the insurance value chain, and one of the things that we focused on ahead of that is how do we automate the processes that can take advantage of the data that might become available. We may not have taken that data on board yet, but we know it's coming, right? And that's critical. So it's kind of planning ahead. So if I can take the property reinsurance treaty pricing process as an example, here we're looking at portfolios of risks from insurers which contain hundreds of thousands to millions of locations. There's a lag associated with the amount of processing that needs to go through that in terms of sheer CPU power as we model it, price it, put it through our systems. But what we have aimed to do and been putting in place for the past couple of years is a really robust framework that allows us to take the data that comes in the door, put it through an entirely automated fashion, capture and trap all the steps such that the analysts are not spending time pushing buttons and the underwriters are not waiting for the results. But it's there instantly. And then the key thing is, because we've got this process automated, now we can start saying, okay, I want to look at it on the baseline data that comes in the door. I want to augment it with some third-party data. I want to run it in 6 different fashions. And it all runs in parallel. It all leverages the incredible compute capacity that's available to us these days. Giving you rather than a single number at the end, you have a nice wheat sheaf and a distribution of what the risks are associated with any new opportunity. And ultimately, what I want to try and do is work out what the difference is between the risk, the amount of capital I have to allocate to that risk. Does this new information mean I need to allocate more or less? Either way, I've immediately got an understanding of what the ROI is on doing that across my portfolio. Because if I can allocate less capital and I have lower volatility around my capital estimate, then I have more confidence, I can take more risk. If I have to allocate more capital, then I know that I'm not overexposed and less likely to fail in the event something does go horribly wrong.
So I want to touch on this because ODN is pretty unique in the space of data providers in that all of our data sources are public information to begin with. There is no secret sauce in the actual raw data, but go ahead, try to use it. Like, get back to me. Give me a call when you realize that the magnitude, the volume, the speed with which it's produced, and the mess in which it originally and raw exists in. So information like traffic crashes, for example, you probably want to know where are traffic crashes in my neighborhood. Well, they're reported in an XY coordinate, sometimes in an address. We do the effort to put it on a roadway network. So now you have like a floodplain map for the roads. You have a hazard map of the roads itself. The competitiveness comes from the unique applications that you're able to build from the raw information. And any data provider out there, and Carby Data, call me on this, right? Data is becoming a commodity. Carriers will tell you that the cost that they're willing to pay for raw data is going down under a nickel, under a penny in some cases per record. So the long-term viability of a company, a long-term competitiveness of a company is not dependent on the raw data asset. It's dependent on how they work with the carriers to produce value for the organization using that. And I want to touch on what we were talking about before about aggregating or consolidating down to real time, right? I think that's one way to restructure the way that data is delivered, right? To make it available, to price the risk in the moment. What's the probability that I'm going to be hit by a car speaking on the stage to you today? Probably pretty low. Do I need to be paying my auto insurance policy right now? Maybe not as much. So there is that future. But what I do think is also fundamentally changing about the architecture of the data is that we're no longer needing to ask only the customer questions about themselves, right? I could ask you questions until you're dead and not get as much information as I can connect to you based on where you are in this moment. The fact and the reality is that the probability of me being hit by a car in this moment is probably more determined by the reality that I'm sitting on a third floor of a conference room than it is by my credit score. And so there's a lot of changes that we can make to actually provide continuous value to the customer by not actually even asking or requesting data from them to inform a policy term, et cetera, but to attach information to them to add value to their experience.
And just to add, you know, when you look at commercial insurance, the data that we get from the different providers is just one piece of what we use to underwrite a risk. We augment that with sending risk engineers on site to do a more, you know, a holistic assessment of the property or whatever coverage we're trying to get. In addition to that, I think as we get new data sources, cover a new type of risks, it's important to make sure that your claim system is also augmented and is also nimble enough to gather some of these elements in the claims processing process. It's got to be then fed back to your underwriter. At the end of the day, all of this is meant to assist the underwriter to write the risk. It's not meant to automate or, you know, fully replace an underwriter, especially when it comes to commercial insurance.
So, Hanny, actually, someone in the audience said you made a really good point about the inherent structure of our business model. So maybe you can, and then everyone can sort of weigh in. What are we seeing in InsurTech to help internal needs for actuarial professionals?
So I think there's a lot of effort being put into it, but it's a non-trivial problem to solve. The actuarial process has been developed over centuries, and what we are considering and the nature of the risks is changing, and that's a critical thing as well, right? The way we've developed this approach to underwriting risk has been based primarily on tangible risks, so property, something that has a value that is very easy to estimate and associate with something. But more and more, and this is why I think we're seeing this shift in the way the actuarial community thinks about things, we're exposed to intangible risks. So, I mean, Richard's business is entirely focused on the intangible risk associated with the price of commodities. But the liability risk associated with trucking contracts and what they might pick up from road traffic accidents. These are all risks that are outside of a value chain and much more difficult to estimate. And that's where the value of InsurTech's bringing together the data with the insight, where that insight is collapsing that insight out of the data sets using data science, using regression algorithms, and using usually fairly simplistic simulation approaches to try and actually estimate what the real risk is in a more, and hopefully faster. Right? Ultimately, we're a service industry. We have to try and get a response and a price back to to our broker, to our client, to our insured as quickly as possible.
So let me take a slightly different approach to the response, because the question was, how does an insurance company basically justify the expense to actuarial? It's a hard problem, right? So coming from the other side of it, I think it's really important to set an expectation. So this data element is going to create this amount of lift for this specific use case, or it's going to create this operational efficiency and drive this, call it 10x ROI based on being able to do X, Y, and Z, right? I think one of the major problems that insurance companies face, at least that we've seen or talking to them, is they say, we want to see your data and we'll go figure it out, right? And that's a problem for both sides, because they don't know what they're looking for and we don't know what they're looking for. And so the discipline is, before looking at it, I expect to get this. And I think that makes a big difference. And I think that makes it much easier for all parties involved, whether it's actuarial, whether that's some component of operations or whatever that is. If I know what I'm going to get, or I'm expecting it, then it will either do that or not, and then I can move forward. Otherwise, again, the experimentation phase is really hard, really expensive, and really slow.
I want to touch on that because I think it's really imperative that we focus on this experimentation phase. Otherwise, you all are going to keep paying an excessive amount of money for the data providers you currently work with, because you're essentially creating a monopolized market for them by institutionalizing the methodologies that you've done for the last 30 years and not asking the question, could this new data element replace or improve on the model if I fundamentally revisited the values of each risk factor that I'm putting into my model? So I agree, and I really want to stress how important it is, because the primary thing we hear when we go in and discuss, a pilot or an implementation is, man, we're really tired of paying so much money from this current data provider. We wish it was a little bit cheaper. And the reason it's expensive is because you're not opening up the opportunity for new data providers, non-incumbents, to undercut the validity and the value of that data with new sources of information that could actually be better.
So that's a really interesting sort of challenge. What do some of our carrier panelists think of that?
So the way that we evaluate data providers when we come in, we understand that there's a lot of nuances that go into really getting a good feel for how good or how bad a data provider is. So we come up with a data set from our own internal source, make sure that everyone on both sides are clear on what the objectives are. We usually have an understanding of what the scores should be, and then we send it out and say, okay, show us what you can provide. And if it's different than what we have, let's sit and talk about why is it different. Are there things that we're missing that you've uncovered? Or is there data quality issues that on either side that we should be aware of, and so on. So I think it's really important that going in, one, you need to have an open mind, but then also make sure that people are clear on what the end goal and the objectives are.
Yeah, I often feel like we're in a little bit of a Mexican standoff with the data providers. It's like, I'm not willing to pull the trigger, they're not willing to budge, and I don't know who's going to get shot, but someone's going to get shot. It makes it very hard. It makes it very, very hard for us, because we've got an existing business model that is profitable, almost, and we want to grow it. So we want to grow it, but we don't want to grow it at the expense of the downside risk. Ultimately, it's the downside that matters, right? Because that's what's going to sink us. But when it comes to the experimentation phase of things, for me particularly, right, I'm looking at, I've got portfolios of risks that are millions of locations. Comfortably, we look at 60 million property risks in the US alone every year, right? As subsets of the portfolios of the people we insure, of the insurance companies we insure. And then when a data vendor comes to me and says, "Oh, we'll give you a free trial. You can run 10,000 locations through our system," I'm like, okay, that's going to tell me nothing. That's going to give me zero understanding of what the ROI is, because the ROI is only going to come to me when I can get an understanding of, does this allow me to make better use of the capital I hold? And I don't know how to get around that. Some people get more flexible about it. And then there's always the challenge of the model, and the pricing model is just such a challenge. If it's a per, you brought up per record just doesn't work for a reinsurer. I just want to know what do you want for all the data?
Percent of written premium.
Sorry?
Percent of written premium.
So perhaps, but that's probably not the appropriate part either, because again, what we're doing there, if we do it in that frame, you're going on exactly the criticism I would make of a lot of the insurtechs that work on the distribution side of things. You're looking to try and take another little slice out of that ever diminishing pie of premium that means it's not being allocated to the risk. It's actually being bled out of the system into expense, and that's what is going to make insurance unaffordable. And I think that was referenced a little bit in the prior session. So it needs to be something that is, obviously we need the data provider to be making a healthy profit, because we still want them to be around in 5 years' time so we can keep getting our updates. But the way it needs to be more thought about is, well, what is the value that we're actually going to be able to get out of it? Because it's not necessarily that we're actually going to grow premium. It may be that we choose, with this additional information, to shrink premium. Maybe it means that we're able to price these risks more effectively, because the volatility is lower, the uncertainty is lower in this risk. We're going to give a cheaper price. That means our premium is going down for the same amount of risk that we're going to take. That's fine by me if my return on equity is going up. What it also means is, what I will now do is I'll look to new business to grow my premium rather than the existing business. So that's a powerful thing that I think pricing model needs work.
So this is all, I think, really good discussion. So let's poke a little bit more. So the audience is asking about friction with IT, and insurance companies have their data in all of these different sort of systems. Richard, I don't know if you want to, weigh in on this, since you're dealing with so many different sources of data, but just the internal systems within an insurance carrier can add a lot of friction to, operationalizing the existing data and new.
It's massive, because we're bringing them new data, and to give you some idea, there's over 3,000 indexes. We run 100 trillion simulations every 14 days. And then we are then showing them the risk and the portfolio and everything. I mean, we made so many mistakes in the early days because we just didn't focus on that earlier point of visualizing that risk. How do we help them understand this? Because this is an entirely new line of business, entirely new risk. And we needed to communicate that far better. Take all of our data science, all of the algorithms, all of those trading sheets, and hand it to them in a way that made sense in their language, so they could understand the risk as well as we could, and help us grow the business.
I think there's a propensity to, as a data provider, sometimes feel like victimized, like, it was the IT department put the kibosh on our project, and it's all because IT messed it up, or they don't have a cloud infrastructure yet, or their innovation lab isn't fully, that's why it didn't work. But I've been reframing the problem as, if I want to be part of the solution, I'm also part of the problem. And so if I can conceptualize our mission and our vision as reducing actual risk, as pricing modern risk, as bringing in customers, target customers that we really want, that the models are no longer working for, like millennials, like women, and the world being a little bit browner and blacker than it used to be when auto insurance was first priced, I need to recognize that that's an opportunity, and to align the IT department, the procurement department, the startup, the executive who has the budget, and understand that value together, because it's a negotiation. It's not a, you messed up and you didn't do your job, or IT didn't work, or the startup messed up. It's that we're all trying to achieve this mission, and mission alignment is actually the most important first step.
So Gurish, all roads always lead to IT. So how do you think about it?
So I think this is a problem that probably every carrier, or most organizations have, right? You start implementing solutions, and then over a period of time, across many decades, you have applications that either haven't been invested in, or the applications that have come in through acquisitions. When you acquire another company and try to integrate it in, it's not just the business that you're trying to integrate. You're trying to integrate the applications. You're trying to also integrate the culture associated with some of those applications as well. And it's hard. For companies that have a centralized, say, a data lake, for example, probably a little better off, but even then, the effort required to get data from multiple systems in the format that you need, in the timing that you need to get the data to be meaningful, is a work in progress continuously. On top of that, if you implement now cloud solutions that are sitting outside, that's just another integration. So companies that have invested in APIs, in data lakes, probably are further along than others. Keep in mind also, when you have a global organization and you factor in multi-language, multi-currency, regulation around where the data can sit, etc., it just adds to that complication. But I think there has to be investment and support at your executive team level to make sure that you have one view and also understand it's a journey, it's not an overnight process.
Thank you. So I want to make sure we reserve a few minutes to talk about privacy and regulations. We have a few questions on that. But Max, why don't you kind of kick off an answer to how do you think about forming a third-party data strategy and roadmaps? How do you become a better data strategists as insurance organizations?
So the first way, it has to be clearly identifying the use case and what you're trying to get from it. So obviously there's so many different types of things, but we're talking about small commercial data. You're saying, okay, I want to do data prefill, or I want to automate underwriting, or if it's about, pricing, I want to segment my rates differently. I want to be able to tell the difference between Joe's Cafe and Old Kings Road, right? And then this is what I'm expecting in order to do that. So it's important, again, to clearly define it, right? Not doing the experimentation phase. But the second piece, and I think this is really important, it ties to the last question about IT, is that you need to have a path to be able to consume it now, but also have a path to be able to consume it as part of a system-to-system integration. So, because this is a really hard problem. And so, because obviously you have these systems, and okay, there's an API. Well, that's really hard to integrate, or it could take a lot of time. So we like to think about this as sort of parallel systems and trying to identify the right seam along the way of, okay, where can we fit in? So on day one, maybe there is a UI, right, that you can consume this data because of that. However, the API is there, and you're working on getting that integrated so you can get the value now. That's such a big problem because it can take, obviously, years. You want to be able to leverage the value now, but still make sure it's part of a fully automated system-to-system process.
I wanted to touch on that and also pick up the question on what's the waterfront view of the future of data. I think it dovetails nicely. The way we've always done it, right, is building relationships and building network. That's our industry. It's based on who you know and who you get an introduction to, and building commitment and knowledge and awareness about other ideas. Well, we're in a modern world, so there are modern ways that you can network. You can reach out to startup accelerators, like the Partnership Fund for New York City is one that we went through. Speak with the data providers you already work with. Ask for their recommendations, right? Get to know their friends. Get to know their advisors, because there are certainly companies in our ecosystem. ODN focuses on auto, but Hazard Hub and Bob Frady is someone I'd love to introduce you to. He's doing fantastic things in a separate line of business, but credibly aligns with our mission vision. We've been able to get to know him on this journey. So it takes some intentionality to network. It takes being more active on LinkedIn. It takes listening to podcasts like The Golf Course. I'll make a brief pitch. But it takes putting yourself out there to network into the community. I think that's one way to strategize and to see what that world looks like.
Well, let's go ahead and talk about regulation. And I don't know who wants to, start off with some thoughts about this. So, Carey, you're talking about, really interesting new sources of data around drivers, et cetera. But, if you think about GDPR, Grish, you mentioned this a little bit. You think about the California privacy regulations. How do you actually, experiment and grow in terms of data sources without knowing exactly what you're actually going to be able to, use in production at scale, or, and what's going to be allowed in terms of where privacy regulation is headed?
I think it's a work in progress because California is just one state. When you do business in every state, at some point or the other, everyone's going to catch up to you. It really is a question of making sure that there is a champion within your organization who is focused on that. Because if you leave it to individual departments or so on, it is very difficult to really get that one holistic view of what you need to be compliant with and not. Obviously, your compliance organization would play a big role in that, but having a chief compliance officer would definitely help mitigate some of that risk. But it is something that I think is going to be a big factor in almost every project or every initiative that we take on, because as different states get familiar with some of the data that's being that's captured by different devices or sources and how it can be used, they will adjust their regulation as well to make companies comply with that.
Yeah, I mean, regulators have been very clear on some of the criteria that they use to evaluate new rating factors. So it needs to be credible, non-discriminatory. They're increasingly, the National Association of Insurance Commissioners is putting out a working paper on AI and insurance. And it's actually, we talk about AI and the smart city space and the fintech space, it's actually one of the leading, I would say, pieces of guidance about how to consider incorporating algorithms and more sophisticated prediction models into insurance. The initial guidance is around life insurance, but can largely apply, and you can use that as a rubric and framework when evaluating new risk factors like ODNs or others.
And so just to touch on that, another approach is to really avoid the hotspots. So for us as a startup, we avoid auto and home and life, right, from a pricing and underwriting perspective, because obviously there's so much controversy around these given areas. But on the claim side, you have consent. And so you can do lots of things on the claim side that you can't do on the pricing and underwriting side. Or if you talk about new data and talk about small commercial, again, a big theme of this conference, right, well, it's the job of a business to put themselves online, right? They make this information available in public. So that's data that is also ripe for experimentation use, leveraging it and using that to predict insurance outcomes. So I think it's really important, and I really hope that other insurtechs and insurtech data companies are very, very, very careful around going in and saying, we're going to your Facebook page is going to have you deny someone's auto insurance coverage, right? That's a horrible thing, and people like to talk about those kinds of areas, but so I think it's important to avoid those clearly obvious situations that will create a lot of controversy.
And sorry, just to add to my earlier point, so it's more than just the use of data. I think many of these regulations also focus on how is that data being stored, how is it being accessed, is it being encrypted? When you transfer the data within the organization or outside your organization, how is it being done, and is it complying with the regulation as well? It does require a lot of investment, not only in time, but also in terms of resources to understand what the data is, how it's moving, and so on.
One of the things that I've noticed with the ever-increasing amount of regulation around privacy is the quality of the data goes down, and that's very bad from my perspective. So properties are no longer sharing addresses for particularly data coming out of Europe with the GDPR regulation there, and that means that the risks are all clustered at the postal code centroid. Now, some perils are very sensitive to exactly where risks are, flood being the main one. So if you're looking to buy flood policy, if you're looking to have flood covered, it's important that that is shared on if the insurance company wants to offload some of that risk. And I think there needs to be some clarity around that. And I think a lot of it's just down to interpretation, and an address is not personally identifiable information. On its own, independently, it's a string of text.
We could have spent the whole panel session on regulation, so we only have about a minute or so left. Richard, to start with you, just what's the one takeaway you want the audience to walk away with today, or one piece of advice?
Just for me, there's a lot of, on the data side, there's some sort of small stuff and some incremental stuff that is obviously important. But for me, it's about just opening your mind to the sheer opportunities that are out there and just taking a step back from day to day sometimes, because I think you can get lost in the detail, and actually just forcing yourself to get out of the business and think on a wider level. For us, we're solving a huge global problem, and that took a long time, but it took me stepping back out and really using it again to solve that problem.
Let's just go down the line and everyone just share your one key takeaway.
Sure. So I would say it's probably that the way we use the data is what's going to be important, and how efficiently we do that. So we've got to do it quickly. And it can't add additional cost to the value proposition that insurance represents, or it's not affordable.
Yeah, I would say that when you start getting a large number of data elements, at some point you got to stop and ask your question. Do you want data quality or do you want data volume? What's your preference at that stage? For us, Zurich specifically, I mean, we would prefer quality over quantity at any given time. So, but the amount of data disruption that's happening, no pun intended here, but I think you're going to find that companies are going to start pressurizing their different data sources to improve the quality, but then also on the quantity at some point.
I would say that any data initiative that is intended to be disruptive or otherwise needs to be bookended by humanity. We need to understand why we're doing what we're doing and who we're doing it for. So if we want to keep people safer on our roads, we can use data to inform the ethics and the values of our business and where we want to see it go. I think that solves a lot of the challenges that we have around building buy-in, being all on the same page about what the mission and vision of our organizations are, and frankly, while it didn't come up on this conversation, having our employees feel like they love their job and are giving back to society. We have a tremendous opportunity to bring value back to people if we think about data in the context of its impact on our own humanity.
So as Kara Swisher said yesterday, anything that can be digitized will be digitized, and that disruption is coming. And I think the big trend moving forward, that's where small commercial is, right? That's where it's going. That will become digitized.
Well, thanks for all of the great questions. We were able to incorporate most of what people were asking, and please join me in thanking our great panelists for a great conversation.